Hello, everyone. It's Larry Kotlikoff back with Economics Matters. I've got a very special guest today, Dan Shaviro. He's a longtime friend. He's the Wayne Perry Professor of Taxation at NYU, New York University's Law School. Dan's a, a lawyer who works on economics, the economics of taxation, or an economist who works on law. We're gonna,
Well,
you
from an
know,
economist, I don't have the degree that says
yeah,
so.
yeah. Anyway, well, it doesn't matter to me. I've learned a lot from you about economics over the years. But Dan is a graduate of Princeton, and then he went to Yale Law School, where he graduated summa cum laude. So that's not an easy thing to do at Yale. I don't know if our vice president, well, I guess he went to Yale Law School too, perhaps, right? But
I think
anyway,
I actually was at Princeton. I was got the summa, not
yeah,
Yale.
yeah,
Yale, I
well,
sort of don't have grades to speak
yeah.
of.
I see. Got it. Anyway, before entering law school, Dan spent 3 years in private practice, and then he was at the Joint Congressional Committee on Taxation. That's called the JCT. That's a very important institution that for years has been independent and come out with excellent reports about the tax system and different aspects of it. But then and then when Dan was there, he worked on the Tax Reform Act of 1986, which before the Tax Cut and Jobs Act was really the most important tax reform we've had in many a long year that we had ever, really had probably since I don't know what the major. I'll let you, Dan, tell us what the major tax reform events were of the post-war period, but certainly '86 was a big one. In the next year, Dan began teaching at his teaching career at the University of Chicago Law School, and that's, I think, viewed as one of the top law schools in the world, if not the top. I'm not sure how we rank these law schools these days, but certainly it's a very important law school. It was and is. Then he moved to NYU, which is also an outstanding law school and has been for years. In 2023, he received the National Tax Association's Daniel M. Holland Medal, recognizing lifetime achievement in and outstanding contributions to public finance. So Daniel Holland was a major figure in the world of taxation and tax, thinking about tax reform, tax theory, and the National Tax Association is a major institution that brings together economists and lawyers and practitioners and people in government to talk about the tax system. And it's been around forever. So getting this award is a very big deal. Dan's scholarly work focuses on tax policy, but also on things related to tax policy, inequality, the intersections between law, literature, and social science. He has a number of books, including The Bonfires of the American Dream and American Rhetoric, Literature, and Film. So that's really not got much to do with taxes or economics, but Fixing U.S. International Taxation, just Decoding the U.S. Corporate Tax, Do Deficits Matter? And he also has a novel called Getting It. And he's got a memoir that just is coming out or came out called Now is Now and Then is Then. So I think it's really, I wanted to have Dan on to make clear that, the economics of taxation is not confined, that discussion of what is going on with our tax system, what it's doing, what it should be doing. That's not confined just to economists. We have a large number of kind of there's a large contribution to this discussion by the legal profession, especially the academic legal profession, at all the major universities. So when you have seminars that economists are holding about one tax issue or another, or what's the implication? What did this tax policy do to that issue, or big issues like inequality? You have in the crowd a good number of academic lawyers, and they're also presenting. So it's always been a complete connection from my days in grad school, many important legal scholars on the tax side were.
Kind of sociologically interesting, by the way. I don't know if we want to get into that today, but the sort of relationship between lawyers and economists.
Yeah.
In a way, the economists sort of have more prestige within the profession, and lawyers have to decide how they want to deal with that.
Yeah. So Dan, take us away here with we're going to ask some specific questions about about your career, but also your views and the I think the first I'd like to know kind of how you got into tax into this area. Let's start with your kind of decision to get into this field, and and then we'll go from there. Okay.
Yeah, I'm sort of a liberal arts humanities type, and I'm also more than a mathematical type. And I'm also from a family. I like to say of my family that if there were two siblings, one was Jeff Bezos and the other one was like the third violinist of the New York Philharmonic Orchestra, everyone in the family would say, it's a shame Jeff didn't turn out as well as his sibling. So it's that type of thing. Anyway, I was in college and I was a history major. Luckily, I realized before my senior year that I both wasn't sufficiently interested in like diving into the archives and not reappearing for air, and also that there are like basically no jobs. So what am I
Mhm.
going to do in those days? Kind of everyone that I knew in college was either like a pre-law or pre-med. So I said I'm going to go to law school like all my friends. I felt I had a skill set that would work for it okay. And then when I'm in law school, I'm going to go into legal practice. Some people told me, several different people told me you should really go into tax. It's kind of tax practice for a junior person. It's more intellectual, the research is easier, and the hours are shorter. So I thought, do I want more interesting research or less interesting? Do I want shorter hours or longer hours? Well, it's pretty easy to answer that. So I went into tax. I went to a tax law firm, started tax practice in DC, and I quickly learned, or maybe not so quickly, but within 3 years, I learned that this was really not for me. And it wasn't the firm's fault. I quite liked the people at the firm. I thought it was a great firm, but it just wasn't the right thing for me. So my halfway house was I went to the Joint Committee on Taxation, and through complete luck, because I had no clue about this, it was right before the 86 Act happened. There's a huge literature on what we should think about the 86 Act, but I'll tell you one thing for sure. It was fun to work on. And I did that for 3 years. It was kind of exciting. You're kind of doing more fundamental things, although, of course, just within a political setting. And you're making senior lawyers. I remember a colleague of mine used to say, someone would give him a stupid argument. He'd say, that's wrong, but go ahead. So anyway, it's kind of like, it was a funny thing. You're a junior person, but you really have the ability to just, if I were to say I had discretion or authority, it was only within very, very narrow bounds, of course, because obviously the Congress and political leaders are deciding things, but it was kind of fun. But I got sick of it and I decided to go into academics. At that
Yeah.
point, I was glad I was in tax for a totally different reason than the practice reason, which was that in the law schools, there are a bunch of subjects that often don't have a firm intellectual foundation. Like I would say that about con law. There are also a lot of economic.
Let's just stop right there. You're
Yeah.
saying constitutional law, like original, what's the
Original intent, originalism.
that has no fundamental foundation?
Well, what are you can have a philosopher who says, here are my fundamental premises, but here there are really no fundamental, it's not quite policy, it's not quite history, it's sort of in between the two stools. And the question of, like, Larry, I know in your work, you have a framework and there's kind of a way to judge correct or incorrect or even better or worse from within your framework. Con law, there's just sort of no framework, or it's all up for grabs. So it's very unsystematic.
So let me
What
just push on
yeah.
this because we've had a lot of decisions based on original intent and people reading into the Constitution. Do you think this is just a political, kind of
Yeah,
decide?
it's basically bunk. Just to give an example, and not to get into politics, like I'll admit my politics are I sort of favor gun control, but the way that the Supreme Court reached their view on the Second Amendment is by taking a historical interpretation that 100% of historians, qualified historians, not 99%, 100% think is bad history and is wrong as history. So I think it's used completely as a manipulative trick, and it's not done in good faith. a prominent colleague of mine in law named Kaz Sunstein wrote an article asking, why is it that when the original intent jurisprudence is completely refuted, it has no impact whatsoever? So common law, I really, again, a country, I think it's good to have a constitution, have it be interpreted, and then you have a sort of inchoate methodology for it. It serves good purposes institutionally if it's done in good faith, but it's not really intellectually grounded in the way that economics or philosophy can be.
So if it's really, just one more second on this, if interpretation of the Constitution is really up for grabs, so somebody says, oh, we need to follow the original intent. Somebody else says, no, that original intent was not part of the Constitution. So, if we really
Yeah, we don't know if the original intent, if the original writers were originalists, that's disputed.
yeah. I mean, if they really wanted us to follow their original intent, they would have said it, I guess, in the Constitution, right?
Yeah.
So it sounds like it's really up for grabs, and another theory could come along about how we should be interpreting the Constitution, and then through time we keep changing. So that's kind of disturbing that
Yeah.
the Constitution is not exactly clear cut.
Well, it's good if it's done to a degree in good faith, even though it's always been the case that the liberal judges and the conservative judges tend to, like, at least 90% of the time, come out the way they want. But at this point, I don't feel it's being done in good faith anymore. So when it's being done in good faith, it's kind of intellectually a little threadbare, but nonetheless, it can be a useful process has some real virtues, but not as interesting to write about from my standpoint because of the lack of fundamental guiding
So
points
this
for
sort
it.
of calls into question the whole idea of stare decisis, right? That
Yeah. Well, everyone favors stare decisis except when they don't. So,
All right, let me ask you this. Okay, so you got into tax academics for a number of reasons. How's the academic tax law changed since you started in 87?
yeah, I have a piece I'm writing that I actually present at the National Tax Association next month, which the starting point for it which is that when I entered law teaching in 87, in legal academic tax law, to an amazing degree, there was sort of a religion. It's like Haig-Simons income taxation. Implementing the Haig-Simons income definition is simply the goal. It's been decided on. There's nothing more to be said except how to interpret it. So that was kind of community with only a few dissenters was united on something that was not Haig-Simons income definition, which we could talk about if you like, has some virtues, but to be a
Maybe just
canonical religious guide is
maybe just tell the listener what you're referencing, because
Haig-Simons. The Haig and Simons defined economic income as the sum of the market value of your consumption plus your change in net worth during the relevant accounting period, such as a year. So, for example, if your stock goes up in value, that's Haig-Simons income, even if we don't tax it currently. And the idea was we just have to figure out what's the right Haig-Simons treatment of A, B, C, or D. It's not a very intellectually nourishing way to do things.
but just to say for everybody that, the basic idea here is that income, you either consume it or you save it. And if you can measure, if you can measure income and subtract saving, then you can get to consumption. So if you really want to tax
Yeah.
consumption, which a lot of economists favor doing, and a lot of tax economists like Dan favor doing, this is the way to get to measure consumption. But we can get into consumption taxation as we go along here. Let's talk about retirement for a minute. It's something Americans think about regularly. Ask yourself, how financially secure do you really feel? Do you have enough money to retire? How much is really enough? And if you don't have enough money, how can you possibly find that extra money before you do retire? These are all tough questions. My retirement software, Maxify Planner, is the powerful online planning tool that takes the guesswork out of retirement. It weighs your assets against your fixed expenses to calculate how much you can safely spend every year for the rest of your life based on when you decide to retire. And it shows you safe ways to find more money. Maxify makes a complicated problem like retirement planning simple. It's accurate, easy to use, and produces what you really seek, peace of mind. So make the smart choice and visit Maxify.com today. Don't miss this opportunity. That's Maxify with an I, Maxify, Maxify.com. Now let's get back to the podcast.
An example of how it's not really a good enough standard, and when this has nothing to do with income taxation versus consumption taxation, is, as you point out, you can kind of do it just for consumption taxation, but like, how should medical expenses be treated? It turned out that figuring out what is the correct Haig-Simons treatment of it just wasn't a very illuminating way to think about the problems, which are quite complex.
So you're saying it's still pretty arbitrary, would be,
It wasn't really the right way to handle all questions. It's a useful, the way I put it in this paper is it's in your toolbox. You should have that in your toolbox, but it shouldn't be a canonical, like quasi-religious doctrine. By the way, of course, if there's Haig-Simons income taxation is the religion, then consumption taxation is ruled out by definition, sort of, rather than based on analyzing which system is better or worse and why.
why is that? Why would you say that?
If you're taxing Haig-Simons income, then you're taxing consumption plus change in net worth, consumption plus saving.
Yeah,
So
so
I
they're
would
focused on,
say,
yeah, they're
yes,
focused on income taxation, not consumption taxation. Yeah,
yeah. So one should really, if one favors that, one should really argue for it in terms of its consequences and things like that.
yeah. Just to be clear, somebody like, I just want to make a point for the audience here, which is like 120,000 strong potentially in terms of number of people, but not very few are economists or, you know, expert, experts in the legal experts on taxation. And economists think about taxing wages, what you earn at work. We think about taxing income, which is wages plus asset income. We also think about taxing consumption, which is out of your resources, how much you're actually taking away from, uh, how much you absorbing and consuming of the economy's current and through time future output. And we think about somebody like Warren Buffett, who seems to have a lot of wealth. We could also tax wealth. That's another. So
Yeah.
income, wages, wealth, consumption, these are all different tax bases. And we can think about taxing like Warren Buffett's wealth. But when you think about Warren Buffett, he's basically not consuming much. So what he's doing is he's accumulating wealth and then he's investing in the economy for other people to work with. Wealth is being our capital, our tools that we make available to other people to use in their production.
Well, in a
Uh,
way, it's still his wealth, even if he allows others to
as
use it
wealth, but
for
it's not,
compensation.
it's not, so if we're taxing, if somebody always consumed nothing but just kept investing and accumulating wealth, you wouldn't necessarily think that was so bad because that person was helping others. Whereas if somebody is a spendthrift, has inherited a lot of money and is consuming a ton of it, well, that's a different story. Then you might want to think the
Yeah.
way to go to
Although
forget.
in some economic frameworks, like our mutual friend David Bradford, who we were both very fond of before his tragic death, would have said a wage tax and a consumption tax are in principle the same thing. And all Buffett is doing is he's consuming later, which of course might mean not by him personally, but by the people who get his wealth after he dies, be they children or charities or whatever.
So that's the other issue. Who will, but of course, Buffett, I think, is giving most of his money to charity or to his kids to give to charity. So
Right.
anyway, just a different way. And, we should be aware that, when we think about the wealthy, not everybody's the same. It's not all people who are just out for themselves because there's a limit to how much really a billionaire can consume.
Well, in our audience, there are probably some people, if you named Warren Buffett and Elon Musk, there are a lot of people in the audience, imagine, who like one and hate the other, though which way it goes might vary.
So anyway, tell us about how academic tax law has changed since 87.
Well, again, when I entered the thing, there's this thing, Haig-Simons is religion. Since then, it's become more eclectic, more interdisciplinary, and certainly in things like choice of tax base, the consumption tax as an option, including, I don't know if we'll get into this, like progressive consumption taxes that, unlike a retail sales tax, have different marginal rates for different people. That's become much more of a player in the academic world. I wrote an article 20 years ago in which I sort of said it's kind of become the new orthodoxy, but then it sort of ceased to be because you think of, for example, economists like at Berkeley, Saez and Zuckman and Piketty, there's been sort of a return to, and the tax legal academics as well, there's kind of been a return by some people to income taxation, but more fundamentally, there's sort of no consensus on these things, which I think is a healthy state of affairs. There's a lot of vigorous disagreement within respectful bounds.
Right. So one thing that I think tell people about is the different ways we can tax consumption. Then I'm going to come back to the issue of the tax base in a second, but maybe you could kind of walk people through. I think one of the very interesting things that has been, developed, we people knew back many years, but is still not at all known to the public, that there's lots of different ways to tax consumption, directly or indirectly.
Yeah.
Walk through a couple of those.
Yeah. So America, we have the retail sales tax at state and local governments. Every other country in the world, pretty much, there's a VAT, value added tax, which is some ways kind of a more sophisticated way of doing roughly the same thing. The issue raised by that taxing consumption that way is you can't have graduated rates. If you you can't ask the grocer to charge you a different sales tax rate depending whether you're Bill Gates or one of us, or a poor person. And it was also thought, well, how can you measure annual consumption? Because what are you going to do? Have to keep all your receipts for the year or something like that? But a couple of methods of having a progressive consumption tax at the individual level emerged. One was, well, there were basically two main things that got a lot of play. One was, it's sometimes called the consumed income tax. So what happens in that is you sort of take your income for the year, which we in principle know how to compute for the most part, but you deduct all saving and you include all dissaving. So again, I say I earn $100,000 this year and I saved 30,000 of it. How much did I consume? Well, I must have consumed 70 because what else could have happened to it? So you deduct all saving, and it's done technically. Might have things called qualified accounts with financial institutions, but you could own anything through that. It could be not just a bank account. You could own art, or you could own stock, or whatever, or have your business in there. So you deduct all your saving, and then you include all your dissaving, including if you borrow money. Again, if I earn $100,000 and I borrowed 20 and I don't save any, we kind of know I must have spent 120 on consumption because where did the money go otherwise? So you have saving deducted and dissaving included. It's kind of an indirect way of figuring out how much you probably spent on retail consumption. So that's one method.
This is
Some,
called cash flow consumption taxation, where there's
yeah,
money coming in and then there's money going out. And if it's going out on net, well, some of the money coming in is borrowing, but also
yeah,
there's income. And then there's money going out to invest, and that's from saving. That's saving
yeah.
equates to investment. And so if you have all the money coming out, the cash flow coming in, and then the cash flow going out to investments, what's left is money that you are that's coming out to
You're
finance
consuming. Yeah,
consumption. It's
yeah.
cash flow consumption taxation.
So the other method is, or the other main method, I think there might be a couple more, is kind of sometimes it was originally the flat tax, then our mutual friend David Bradford developed a version called the X tax. So to think about that from an American standpoint, if most of your audience is American, start with a retail sales tax like we have, and then convert it into a value-added tax like everyone else has. The big difference between a retail sales tax and a VAT is in a retail sales tax, you simply ignore all transactions that occur before the retail stage. So like if a lumberer cuts down a piece of wood for a baseball bat, then sells it to a baseball bat company, then sells it to the sporting goods shop, none of that is taxed. Then when you buy the baseball bat for your kid's little league, at that point, the retail sales tax is charged. In the VAT, each prior stage is taxed but also deducted. So if the baseball bat company pays the lumberers, $100, the lumber includes $100 and pays tax, and the baseball bat company deducts or credits $100 and gets a portion of it back. So the net tax on that whole transaction is zero. So the difference sort of between a retail sales tax and a VAT is that you have net tax of zero connected collected at each stage under both, but in the VAT, you have an inclusion and deduction. Well, why is that worth the trouble? The reason really is to have a paper trail. Like, for example, if your sporting goods company says, yeah, I didn't sell any baseball bats this year because they turned off the cash register, they kind of will be a little embarrassing if they then are claiming a credit for having bought the bats from Rawlings Company. Where did the bats go? So it's for auditing, it's sort of better to have a VAT. Creates a trail and it makes it harder to evade. Anyway, so you take that, so that's just a retail sales tax with better enforcement. And then you add one more thing, and that is that in a VAT, only interbusiness transactions are counted. So paying wages to your employees, the business doesn't deduct them and the employee doesn't include them because the employee isn't, quote, a business. We all know that retail sales tax in our system isn't charged on paying salary, and also the company doesn't deduct it when deciding how much retail sales tax to pay. So the one extra step that the X tax or the flat tax do is you do deduct the payment to the worker, and the worker then includes it. And now you can apply graduated marginal rates to the worker's salary. In
So
the
it's,
flat tax, it was just like an exemption amount, then a flat rate. And Bradford's X tax, you could have 7 or 12 or 100 rates for that matter, whatever you want.
so let me kind of elaborate here that we have taxation at two levels, business taxation and also household taxation. The businesses could be taxing us when we buy things, but they can also be paying taxes that they then pass on to us in effect when they sell things, and they get some revenue, they get to deduct certain expenses. And so there's taxation at that level, which can, if it's designed correctly, and there's different ways to do it properly, can lead to a proportional tax on consumption, or if, but so proportional means that no matter how rich you are, everybody's paying, let's say, 25% on their consumption. But there's also ways to do some of that, but also allow companies to deduct wage payments, for example, so consumption that's being financed by wages is in effect exempted at the business level. But then when you receive your wages at the household level, the personal level, then you have to report those and pay taxes at a progressive rate. So I just want to get across the idea that we have this multi-level tax system, and we can get at consumption taxation. We can, if we want, and we talk about the advantages of consumption taxation in a bit, but we can produce or effect a consumption tax by using a combination or just by of taxation at one level and then the other as well, or just use one level of taxation, but we may not get to the same degree of progressivity that we want. So maybe, Dan, it's worth interjecting here your views about consumption taxation and how it connects to this discussion of inequality that you were alluding to, that Piketty and Saez and Zuckman, they've been focusing on inequality in wealth or inequality in income or inequality in wages. And they've said that's the stuff to tax because we have too much inequality in these things and we should be taxing that. And my view is that that's misplaced or misguided, and that what we really care about is inequality in consumption, and that our tax system may, unless you really look at consumption, which is, the consumption we're doing after we've been paying taxes and receiving benefits after the fiscal system has done its job. Unless you look at that, you can't even know what inequality we're starting with. So I think
By the way, you are a co-author of an important recent paper, along with Alan Auerbach and Darrell Kohler, I think it is, that proposes a system called lifetime spending power. You're not proposing it in that work as a tax base, but you're proposing it as a way to measure progressivity and also to see how progressive the tax system is and how unequal the society is. And in your measure of lifetime spending power, you include money that a person does not consume, him or herself, but say gives as a bequest. And you do so for a very logical reason, which is that suppose I'm very wealthy, I don't consume all my wealth. I'm not worse off because I didn't get to consume it all unless I sort of died prematurely. I chose to. So I'm in my own mind, I must have been better off doing what I did than if I had consumed it all. So in that sense, your measure doesn't just look at consumption, but at lifetime spending power, because that captures better the where a given individual is, what his or her options are, and so forth. So if you try to operationalize that as a tax base, and I have no idea if that would work, you would be looking not just at consumption, but also at the power or the ability to consume.
Yeah.
Want more money, less risk, and a better life? Buy Money Magic, a new book by Lawrence Kotlikoff, Boston University economist, personal finance expert, and best-selling author. Whether it's education, career, marriage, housing, investing, retirement, Social Security, IRA, or 401k decisions, Money Magic delivers scores of secrets to raise your living standard. Financial journalist Jane Bryant Quinn says Money Magic is a must-read. Nobel laureate George Akerlof says Money Magic is quite probably the best financial advice book ever written. Financial guru John Malden says, you'll love this amazing book. It's full of wit, wisdom, and startling paths to a better financial life. And columnist Scott Burns calls Money Magic a funny, brilliant read, offering wildly powerful, unconventional choices that can literally change your life. Get Lawrence Kotlikoff's Money Magic today at Amazon, Barnes & Noble, and independent booksellers.
So I think that that's what we need to be looking at when you do look at it. I'll just refer to this paper for a second, which is at kotlikoff.net. If you just search under articles for progressivity or Auerbach or Allen even, you'll find it. And it came out in the journal Political Economy in 2023. But it's a major new view of inequality because it's not looking at income and ignoring the redistribution through the fiscal system, or wages and ignoring the redistribution or wealth by itself. But it's saying, let's look at the spending power that people have, taking into account the fiscal system after we incorporate it. And it turns out, just as an example here of what we found, if you look at 40-year-olds, people in their 40s, and you think about their total spending power, the top 1%, the richest 1%, aligned based on their net wealth and their human wealth, the present value of the labor earnings, the resources. So you align people from top to bottom based on their lifetime remaining least resources, richest to poorest. The top 1%, they get to consume, their spending power comprises 11% of the entire cohort's spending power. The bottom 20%, the bottom 20%, their spending power comprises 7% of the cohort's total. Whereas if you look at, so that's very unequal, 11% for the top 1%, 7% for the bottom 20%. But if you look at the wealth inequality of this cohort, the top 1% they own 29% of the total cohort's wealth. So it's not 11%, but 29%. And the bottom 20%, they own only 0.4% of the cohort's wealth. So if you look at spending power after the fiscal system is being incorporated, things are much more equal than if you look at wealth by itself, inequality in wealth, or inequality in income, or inequality in wages. Just to say, then I think that's what economics says we should be looking at. But anyway.
Well, I would quibble that a little bit. Again,
Yeah.
your work does a really fantastic job of working out the logic of an economic framework in which people are choosing. The idea is kind of if you took Econ 101 in college and you had like a two goods model where like how much do they spend on pizza and how much do they spend on movies, and those are the only two goods. and you choose so that you get the marginal utility of the last unit of consumption is the same from each. If you're getting less marginal utility from your last pizza, you should eat less pizza and watch more movies and vice versa. But I've written an article about your method, which I praise it as it deserves. But I say that that is a more challenging assumption for people to apply across a lifetime. The idea of the model, and it has a logical point to it, is if I earn money at age 20, or if there are complete markets and consistent rational choice, if I earn money at age 40, I won't spend it at age 40 unless that's the right time to spend it. I'll spend it at age 20 if I can borrow against it, or I'll spend it at age 80 if I can save it. And I would just say that I would argue that people are, apart from things like changes of information, and you explicitly don't address risk in that article. People have a harder time doing that. It's a sort of a more challenging choice. There's a lot of sort of behavioral economics evidence that people do irrationally spend stuff in period. And given the complexity of the choice, I think that shorter term models are not completely incorrect. They would be completely incorrect if people were kind of better at all this.
Yeah, but I don't disagree that this is, subject for conversation, and that we don't have the last word on this, on how to measure inequality. But the point being that there's no uniform, the fact that somebody puts out a paper on income inequality and how bad it's gotten over time, or wage inequality or wealth inequality, and leaves out the whole fiscal side, which is largely involved in redistributing across generations and within generations. That to me is not good economics. You can't
I think
ignore.
you're right. I agree about that. Yeah. And there are also some of these things, there's sometimes labeling games involved. Like, for example, is the refundable version of the earned income tax credit, low-wage workers get money back from the government for working. Is the refundable part of the earned income tax credit, is that spending or is that a tax reduction? Those are sort of, I know this is something I know you strongly believe in, but I fully agree with you. It's playing empty language games. It really doesn't matter what you call it. But I would say, in terms of I agree with you that using those other methods those other measures can be a bit question begging. Uh, but this is again, in terms of things that have changed, at least in my perception, since I entered academia. I'm much more worried about the problem of high-end inequality than, and I'll call it wealth concentration, recognizing that the term can be challenged. I think it's both much worse, and I'm sort of aware of it's being worse than it was 40 years ago. And I think of that as having sort of negative externalities, is the way I would put it, just like smoking, or just like running a factory with a smokestack creates pollution that makes things worse. I think there actually is a lot of sociological data suggesting that very unequal societies are unhappier and more conflicted. And if I had to say, why is the United States in the political fix that it is today, I think one of the reasons would be that the sort of rampant high-end inequality and the power of people in the top, and how this affects perceptions and lived reality for everyone, has made things worse. So that's why I'm more concerned about high-end inequality than I was 20 or 30 years ago. To quote Keynes, has your opinion changed? And he said, well, if the facts change, I change my opinions. What do you do? So I sort of feel like that's why I've gotten more concerned about that issue than I used to be. Again, whether or
So,
not wealth is exactly the right term.
yeah, how would you describe, we have a lot of tax policy going on right now, which is the whole tariff negotiations. So, I'm reading today in the morning news that President Trump, first of all, he's made just some kind of an agreement with Japan yesterday, that and today it was Korea, and tomorrow will be China. Is this the art of blowing the deal as opposed to the art of the deal? It seems like he throws out tariffs, and then people say, well, guess what? You're not going to get any rare earth minerals from us, and we're not going to buy your soybeans. And then he caves. What, do you think there's anything on, you think we're actually ending up I mean, having, the fact that countries relatively broke, basically insolvent given our long-term fiscal projections according to the CBO and other studies. And we do need revenue. So had the president said, look, we need revenue, and I'm for a 10%, 15% across the board tariff. And I think most of that, at least half of that, will be borne by foreign suppliers because they've had a relatively, kind of a monopolistic position vis-a-vis us. And we'll go this way. Is that where we're ending up with low-level tariffs and lots of enemies as a result of people being insulted along the way?
I agree that like having a 10% uniform tariff would be better than what we're having. I mean, I would probably set the tariff rate at 0% myself, but this sort of the process here, like a province in Canada runs an advertisement on TV saying that Ronald Reagan opposed tariffs, which is at least 99.5% true. And then the child in command raises Canadian tariffs and says not going to negotiate with them. To which the Canadian response is, great, we've got friends in Europe and Asia. We don't need you. That's not very wise policymaking. So there are two things. One is that I think tariffs in general are a bad idea, even given the need for revenue. But the sort of idiotic and impulsive and erratic way it's being done makes the harm a lot worse.
Yeah, I mean, I've been concerned from the beginning of this and the prior administration that there would be over time a realignment. But, in business, you want to have reliable business partners. And if you can't rely on the U.S. to be a good market for you, then you do look elsewhere. So Canada can sell their lumber, for example, all over the world, right?
Yeah, it could be that the U.S. is becoming, short of North Korea, the single least reliable trade partner you can imagine having.
And may also be with respect to national security issues because of the close, connection between Trump and Putin. We're not quite sure how much aid Ukraine is actually getting, whether it's getting any aid under the table, but in terms of actual bills that have been passed to provide military equipment and other support to Ukraine, I think it's been zero. We're allowing supposedly Europeans to buy military equipment to donate to Ukraine, but
yeah, we have never known what the story is with Trump and Putin. I think that someday we will know, and it won't make for pretty reading, but we certainly don't know right now exactly what it is.
yeah. So let's talk about some of your kind of your academic processes. How do you decide what sorts of topics to write about and how to write about them?
Well, I'm a sort of a little bit of a arbitrageur, you might say. I kind of look for things that I feel I have something to say about that haven't been fully developed, and so I can kind of like there. When I deal with economists, there's some of them, not you, but there are some who are like they have really good skill set for econometrics, but they don't fundamentally understand economics ideas at an intuitive level. The really good economists do, and to even ignoring present company like Alan Auerbach and when he was alive, David Bradford, people with superb intuitive grasp of economics ideas. And one of the I have to some extent I'm interested in current issues, but I'm not a kind of like a headline chaser or like a new announcement just came out. I'm going to be the first one to comment on it. I'm looking for things that I can sort of unpack intellectually. And one of my main tricks, I guess, which I learned really from David Bradford when I used to work with him, was sort of decomposing things, breaking them into their parts. An example where David did that is, what do we think about the estate tax? What David would say, you call it an estate tax or estate gift tax, it's really three things. It's a tax on work, it's a tax on saving, and it's a tax on bequests or on gratuitous transfers. And you really need to think about each of those three elements. That sort of thing has kind of been I feel gained insight from applying that. An example maybe in my work that's a little bit, for wonky or for insiders, but before the 2017 Act, people thought about how the U.S. taxes foreign source income. We had a nominally worldwide system, which, Apple is taxed on its profits in China, although it got to defer them and so forth. And I said there are really two margins here, and they're distinct. One is the tax rate on foreign source income. The other is what I called the marginal reimbursement rate for foreign taxes. Foreign tax credit is a 100% reimbursement. And again, this is sort of insidery stuff, but it really helped, I thought, to break these two margins apart and to think of them separately. So there are two separate margins here, and they raise different issues. We really need to think about each one distinctly. So that's kind of like a lot of my work is sort of doing that sort of type of thing, of breaking things down into more fundamental parts.
I'd like to talk to you about a really powerful financial planning tool to help you make smart retirement and other critical financial decisions. It's a tool that factors in all your financial data and shows you what you can sustainably spend every year for the rest of your life. That tool is my software company's Maxify Planner. It's incredibly powerful, it's accurate, and it's easy to use. Maxify takes the guesswork out of financial decisions at every stage of life. Its focus is on raising, de-risking, and sustaining your living standard. Maxify lets you run what-if scenarios to see how your finances will change in taking new jobs, buying a home, doing Roth conversions, retiring early, downsizing, investing more in the market, you name it. Knowing the impact of these decisions before you make them is the secret to making smarter decisions. And it's also the secret to what we all seek, which is financial peace of mind. So please visit Maxify.com today to start planning. That's Maxify with an I, Maxify.com, Maxify.com. Now let's get back to the podcast. So Dan, thinking back your career, your knowledge, your work, let's say you were the czar. You were somehow we could slip your brain into the president's head.
It's a frightening thought. Do I get his brain?
What would be your ideal tax? What would you do to fix the tax that we have? Just as background here, our tax system is not just where some entity of government is saying, if you do X, you have to pay Y. Our tax system is also, if you do X, you get to pay negative Y. We have, and that's our benefit system in the country. If we think about something like the food stamps program or the Section 8 housing or Medicaid or the variety of different basic welfare programs, SSI, supplemental security income. We have these federal programs, and then there's 51 state varieties of them because every state has their own version. So we have
sometimes within a state there are more versions.
Yep, there's like ACA, the Obamacare Affordable Care Act has something like 3,000 different systems because they're localized to what subsidy you get and on the premium, but also on your out-of-pocket expenses connects to the locality that you're living in. So I think there's around 3,000. So we have at least 500 major fiscal systems in our country, and because of these, we are because all these things have been designed piecemeal without anybody looking at the overall impact. We are locking a very large share of the elderly, of the poor, of low wage workers into poverty.
Yeah, because they will lose. There could be a scenario where you earn $1 more and you lose more than $1 of benefits or pay more taxes.
Yeah, Alan Auerbach and I did a study. We're working with Victor Yees, a former grad student, and some other colleagues. It's been a multi-year study, but it's showing that the marginal taxation, lifetime taxation, if you earn an extra $1,000 in present value, how much more do you get to spend and how much you have to give away to some government, federal, state, on net. And then for about a third, I'm sorry, a third of the lowest 20% of resource Americans, so the poorest 20% of Americans, about a third are facing marginal tax rates above 50%.
And you're counting things like, for example, you lose Medicaid, so now you have to.
And we've seen tax rates as high as 22,000%.
Yeah.
Because you earn an extra 1,000 this year, you may start losing SSI and Medicaid for yourself, this year because you went over this threshold, this asset test threshold or income test, and then you save some of it potentially. Next year, you again go over the threshold and maybe even the following year. So you can lose tens of thousands of dollars by earning that extra $1,000. And
Yeah.
yeah, and of course that's, not too many people at the very extreme, but we're talking about, if I can look at it like this, if you think about the marginal taxes and here's on the horizontal axis, lifetime resources. So what we have is this cloud of marginal tax rates, some very high, some very
Yeah.
low for the poor. And then the cloud gets smaller, but it's drifting upward so that
Right.
top 1% are facing median marginal tax rates are above around 55%. So it's not like we have low marginal
Yeah.
taxation for any resource group.
Yeah. By the way, this is a good example of the division of labor in our field because I actually wrote some pieces like discussing this problem like 25 years ago, at which point I'm sure you and Alan also were reading about the problem. So I put my finger on it, but you guys are the ones who are going to measure it because that's not one of the things I do. So that's
Yeah.
look forward to hearing about that. Anyway, I guess if I was the czar, if I were the czar, we won't contemplate brain transplants, but I think I would probably have a progressive consumption tax plus something to address what I think are the problems with extreme high-end inequality, not specifying what that would be because I don't know. Since I'm not the czar, no one has asked me to do that. Plus, on the low end, I would both try to have. I myself am in favor of sort of the so-called UBI demo grant, kind of cash grant to everyone, universal cash grant. I would probably make it more generous than it is now. I'd certainly be concerned about the phase-out rate, and I might convert a lot of some things into cash, but actually, despite the fact that in sort of kind of very in pure economic reason, you'd say give someone cash because it's the best, then they decided to spend it. I think nonetheless, there are arguments for some non-cash things. So I would have, for example, I would have health, well, I'm not a health expert. I would certainly have more universal health care provision. And if it's not universal, I'd sort of make sure the poor got it. Even food stamps is a harder case in terms of using food stamps rather than cash, but there actually are some arguments for using food, I suppose. One of the arguments would simply be that if I'm a voter and I'd be willing to give poor people more food than cash, then it's kind of politically efficient in a way to do that. Anyway, so I would have more at the bottom and at the top, opposite directions, obviously, plus the progressive consumption tax. The other problem, which we haven't talked about, obviously, it's one you're very mindful and have written about, is the long-term fiscal gap. And on that one, although I feel it is desirable to start addressing it, I haven't really, the sheer magnitude of the problem, plus the fact that no one's going to listen to me anyway, and it's not necessarily analytically interesting to work it out. I don't know exactly what I would do with that, except that I would want to start addressing it right away.
Well, I think some of the things you mentioned, like, if we could go, we're spending on healthcare 18% of national income on healthcare at the national level. About 10 or 11 percentage points of that are federal government. But take a country like Sweden, they're spending 11%.
Yeah,
The difference is that Sweden is getting 24th best results, and we're getting 21st best results. So we're spending
yeah.
a whole lot more and doing a whole lot worse with respect to healthcare delivery.
Well, we've kind of like made a bizarre use of markets. We have healthcare is provided privately by in the markets, but it's subsidized by the government, so the incentives are kind of all askew. Yeah, the healthcare situation in the U.S. exactly for the reason you said, which is namely spending, seemingly not getting full value for what you're spending. That is a huge problem, not one I specialize in, but one I'd certainly want to
Right.
figure out how one could address it.
But it also gives us, fortunately, we have a big problem, and fortunately, we can operate on it. If we had terminal cancer, it would be worse than having benign cancer that can be. So the fact that we have a healthcare system that's costing so much, and that if we just adopted the Swedish system, let alone other proposals that I and others have worked on, you have worked out, probably thought about, that make much more sense, we can save potentially 7-8% of GDP, and that can really handle most of our fiscal problem.
But yeah, the transition is going to be difficult. People
Yeah.
are attached to the current health. Also, I think and maybe it's typical of the United States in a way, we provide the best high end. I think we provide great high end healthcare at the very top if you can pay anything. And it's just like, for example, in education, we have much worse public education than most peer countries, but our universities, our research universities and elite universities are the best. So it's kind of weird. We do the very best, but only at the very top and not very cost effectively.
Yeah. What do you think about inheritance taxation? Since we're talking about, as part of your schema here, you're thinking about going after the wealth of the super wealthy, not going after them, but trying to treat everybody else to tax to get some degree of equity and in our society. When you have Elon Musk having more wealth than 52% of the American public by himself.
Yeah. I'm
Now,
a bit conflicted on that because there are virtues, both the argument you were making before about saving and all that, and also kind of like when you give to your kid for altruistic reasons, in a way, there's sort of an extra benefit from being done altruistically, not making the kid render service for you. But on the other hand, I do think that it's the transmission that causes the problem. It's not when you talk about saving, someone saving for his or her own retirement is not, I think, causing negative externalities. So I think inheritance is probably something worth addressing, even though I am a little conflicted on it because there are virtues to it. It's funny, I think the American public, everyone supports the parents' right to give wealth to the children, but not everyone likes the kid getting the wealth, which is then, quote, unearned or unobserved, undeserved. Of course, you can't allow the parent to make the gift and not allow the child to get the gift because that's internally contradictory. So it's kind of a tough
yeah,
choice.
my view in inheritance tax would spread the money. You'd have more of a incentive to distribute, especially if it was a progressive inheritance tax, which it truly would be, to spread it out and also to give it to charity.
Yeah. Also, when you say inheritance tax, the audience may not know, and you and I both, an estate tax, it depends on the size of the estate. An inheritance tax, the difference is it depends on what each individual inherits. So yeah, so if I had a $10 million estate, under the estate tax, I'm going to pay the same tax no matter what. But under inheritance tax, if I spread it 50 ways rather than giving to one person, there might be less tax paid.
Yeah. So Dan, let me turn us to close things up here. Asked you about your you have this interesting, you've got some books here that have nothing to do with taxation or law, and I just want to ask you to address those a little bit.
Yeah, so I've kind of, again, I'm sort of a writer and I like writing. And so I've written, I guess the things I've written that are not standard issue within the field are one, I wrote a novel. It's kind of a satirical novel about grunts in a law firm competing for a valueless prize. It's sort of very sarcastic and satirical, based on P.G. Wodehouse's style, but it's sort of nastier. It's about associates competing for a partnership and whoever under sadistic oversight, and the chief antagonists are a liar, a hypocrite, and a true believer. So the question is kind of which is worse, the person who believes all that stuff or the person who's completely fake and pretending to believe in it. And I wrote this memoir most recently. That was really just sort of an exploration,
What's the name of the first book in case people want to
getting
know?
it,
Get it.
I won't getting it, which is a triple entendre, but I won't, won't explain that here. The memoir is just something, it's something about my first 29 years of life, kind of my current phase of life crystallized when I was 29 because two things happened. I met my now wife, and the other is that I got my first law teaching job, and I sort of became kind of the person I am now. So this is kind of about how I got there, and it's in the form of vignettes. I don't think anyone wants to read 20 pages of my talk about my family. So it's just composed of vignettes that average like 500 words each, little you are there in the room types of things. Really fun to write, and I hope to read. The third thing, you mentioned my literature and uh, books, which are two in number. And the idea there was that the initial idea was that high-end inequality if it raises issues, it's not just due to like the declining market utility of a dollar, so that Elon Musk doesn't need a dollar as much as you or I do, and we need it less than a poor person does. It's the sort of sociology of it. And this went back to when I was a history major in college. So my idea was that literary texts are kind of sociological evidence of underlying attitudes. And this is actually relevant indirectly to tax policy because if there are problems with extreme wealth concentration, for example, it would sort of show up sociologically, but it's also just for fun and to kind of explore, and also about things like even things I'm not academically expert about, like issues of race, gender, sexuality, things like that, about how the novels reflect attitudes and show, and actually are in a way more insightful than if the same authors had written like essays about their views on these issues. So those two books were sort of for fun, and but they are, I think they are academic books, which the other two are. The memoir and literature aren't, and I invite the audience to see if they would enjoy reading them. One is called Literature and Inequality, and the other one is called Bonfires of the American Dream.
So give us your website so everybody can know how to check out. If they forget these titles, they can go and find them and then go to Amazon, whatever.
Yeah, probably either danshaviro.blogspot.com or actually on Amazon. If you search my name, you'll find,
Shaviro, right?
yes, it was the battle of my youth to say that that's the right way to spell it. It's not Shapiro, it's not Shaviro with an SCH, it's just Shaviro,
Yeah.
which is a completely unique name in the United States with the exception of my immediate family members. It has to do with how, and you know, when my grandparents came over to what is it, Ellis Island or whatever, 100 years ago, that's how the name was. The Ukrainian or Jewish Ukrainian name was turned into an American name.
So my grandfather was born in Kiev, so we're probably relatives.
Yeah.
No, surely, but well, I think we're all relatives going back long enough, everybody in the world. But clearly, but I think I want to conclude just by I want to say something we haven't kind of brought up here, which is that you've made a huge contribution to educating lawyers via your seminar on tax and the law at NYU that you've been holding for years. And you've had a whole series of very interesting speakers. I can't attend them, unfortunately, because I'm here in Boston. I've come a couple times, but I see all these bright young lawyer students from NYU and other places sitting there hearing from people like you and Alan Auerbach and top economists and top tax lawyers. And I think that's a huge contribution that you've made to our society.
Well,
We
thanks. Luckily, it's also fun, sort of.
Yeah, it is fun. So anyway, I'm glad that we got you at the middle of your career and that you're
Well, I might be towards the back end a little bit.
no, you just started out.
Okay, well,
You're
that's
going
good to
strong.
hear.
Let me just, as somebody who works in personal finance, give you your best retirement plan, which is to retire 1 year after you die
Uh,
and to be
how,
buried.
how will I teach how will I teach that last year?
Yeah, well, that's, yeah, to be decided, or determined. But anyway, make sure your casket is well Wi-Fi'd, let's put it that way.
Yes, I guess that's, yeah.
Yeah, but no, keep it up. We need you, and we need you to be teaching all your fantastic students for many years to come, and adding your, contributing to our knowledge and wisdom and common sense in these troubled days. So
Well,
thanks again.
thanks. I appreciate that.
Yeah. Well, thanks so much, and we will get you back on.
Great, thanks. Yeah.